Hello, I am David Gerald, President of SIAS. I'm very pleased to bring this roundtable discussion together with DBS Bank. We are today going to discuss issues relating to bond investing. As you know, in recent years, there have been some 13 defaults in bond investing, and this has caused losses to investors. Investors, when facing this sort of defaults, are not sure why it is happening. The expectation has been that there will not be a default in their bond investing. They do not seem to understand how issuers work, trustees' roles, and how the banks adopt processes to distribute the bonds. They are also not organized like stock investors. Hence, this discussion is supposed to be an investor education discussion this morning. We have gathered together a very distinguished panel. Let me introduce them to you. We have Mr. Chew Soo Tat on my right, Executive Vice President, Singapore Exchange. We have Mr. Lee Eng Beng, Managing Partner of Raja and Tan. Ms. Tan Soo Shan, Head of Consumer Banking Group and Wealth Management, DBS Bank. And finally, Lim Se Boon, Chief Investment Officer, Consumer Banking Group and Wealth Management, DBS Bank. Well, a very good morning to all of you.
Hello, David.
Morning.
Hi. Morning.
I think it will be very useful to bond investors and those who wish to invest in bonds to know what is a bond. Let's get to the basics. Let me start with Chew Soo Tat. What is a bond and how does it differ from a stock?
Well, in essence, a bond is an IOU. So for an investor, he has received an IOU from a company that he has invested in. And what that means is that when someone borrows money from him, he will expect to be paid his interest, and over a period of time, depending on when the maturity date is, he hopes to receive his capital back. So that's the essence of a bond, which is he has received an IOU from a company. Having said that, in any kind of IOUs, sometimes the one who owes doesn't pay up. So he has got to be prepared potentially for that. The difference with an equity investor is, I own you. You're a part owner of the company. So as you invest in a company, you participate in the growth of the company and also the risk associated with a company. But you do hope that the company succeeds, and sometimes companies and their business models also may not succeed. So there are risks in all elements of investing, whether it's a bond investing or equity investing. Investors should be cognizant of those risks before they participate.
So the expectation of a guaranteed payment is not correct.
Well, the hope for a guaranteed payment, which are the terms of the bond, will, if the issuer is able to pay, will be certainly something that the investor hopes to get. But there is no certainty that he will always get it, because there could be cases where companies, notwithstanding the best of intentions, because of the economic cycle, may not be able to fulfill the obligations. Investors very often themselves also have that experience when they are themselves borrowers, and they go to the banks to restructure their debts when some of these things happen.
In the case of a share,
Yes.
of a stock, I'm buying into
Yes.
the business. I'm buying ownership of the
Yes.
business. In the case of a bond, I'm lending money to the business. And in the case of a bond, the reason that why there is a perception of lower risk is that bondholders are entitled to cash flows whilst the cash flows are there, whilst the equity shareholders are only entitled to a dividend as far as profits allow it to be paid. So in other words, there is priority for bondholders over the cash flows, and also in the event of a winding up, they have some priority over the assets below the secured shareholders. If they are unsecured debentures, as the ones we are talking about, Sing dollar bonds
Yes.
are unsecured debentures, they rank below the secured shareholders or the collateralized lenders. So there is an expectation of some priority, but it's of no use if the company cannot pay. They
Let's
have
ask-
priority, but if there's
Yes.
no money there, you have priority over nothing.
Yes, is that right, Eng Beng? That's the legal position.
That's correct. In fact, I think investors have to be very mindful that as far as debt is concerned, it can be sliced many more times than, say, classes of shares. And they have to really understand the bond they're buying. Is it secured? Is it subordinated? Does it rank generally with the trade creditors? Or are they subordinated to the trade creditors? Do they have some sort of security? I think all that actually defines the risk that they're undertaking. So they do need to be mindful of these features.
So they need to know where they stand in terms of prioritizing their
ranking.
Yeah,
Yes.
the ranking, isn't
Yes,
it?
and in today's world, there can be a lot of elaborate financial arrangements and ways to structure and prioritize debt.
And Sushan, there are different types of bonds, the retail and the non-retail. Perhaps you could tell the viewers, what are these types of bonds?
So, all bonds should be risk rated according to their risk profiles. Some have public ratings from S&P, Moody's, or Fitch. Some don't. And then you have also the institutional class and the retail class. In Singapore, the retail bonds are listed and they trade in pretty small sizes. Sometimes, only a few thousand a day. And they're quite small as a percentage of the whole Sing Dollar bond universe. Most of the Sing Dollar corporate bonds that were issued in the last 3-4 years were the institutional tranche, which are sold primarily to institutions and accredited investors. And technically, it means that you have to have a personal net worth of 2 million Sing dollars, of which only 1 million of your property counts as equity. And the other million has to be in liquid financial assets. And you have to have 300,000 Sing dollars in annual income.
Okay.
So that counts towards an accredited investor. So the unrated bonds and the institutional bond classes tend to be sold to these accredited investors in Singapore. So whilst there are the two-pronged market, the retail market in itself is pretty illiquid today for the Sing Dollar bond market. The institutional class is a lot more liquid, but even then, the market forces are such that these are OTC, over the counter. So we rely on market makers to make a bid price and an offer price. When things are good, you have ready market makers who will make a bid offer price.
Yes.
The problem with fixed income is that it is a binary outcome. If the company is fine, it will pay you back, there will be bid offers. If, for whatever reason, an extraneous event happens, the price of oil collapses, these companies go bankrupt, there's no in-between. It's a binary outcome. It's surviving today, it doesn't survive tomorrow. In which case, the market makers are not obligated to make a price if they don't want to in the event of a default.
Yes.
Which then means that because of the binary effect of this fixed income, it might be quite hard to find liquidity when you need to get out.